All right, everybody, welcome to the next Commercial Real Estate News and View show. This is a show of the U.S. PropTech Council, and my lovely guest today, I have two in the house, and probably someone else will pop up here soon. Paul and Deanie, welcome to the show. Welcome.
Pleasure to me.
All right. This is a show where we talk about all things commercial real estate, the latest news, and, we have a couple of opinions here or there. We have a couple of opinions. So we do have Mr. Taylor in the house, so this is super cool. And so we always have, I like Deanie because he gives us a different perspective because he's been in the medical real estate space forever and a day, but I don't need to give him his bio. He can tell you what he's been doing. So introduce yourself, Mr. Taylor.
Yep, Deanie Taylor, responsible for strategic relationships at Health Peak. Been in the healthcare space about 45 years, too long, and probably going to be in another maybe 10 or 15. Who knows? It's exciting.
Go for another 50.
There you go.
Come on.
There you go. There you go.
I'm not going to say. You're only 20. You've been in this space forever, but you're only 20.
But anyway, that's glad to be here.
All right, Mr. Sheedy. The
Hi,
Irishman
Amy.
that's lost. The Irishman that's lost. He's in London. He's lost.
So I've been in sort of AI for a long time, before it was ever called AI, back 20 years now. And we work on smart building technology, and very much I am one of these people. I embrace sort of technology companies. Let's all get together. Let's make it a non-siloed tech community, and then let's go into corporates and break down those walls. I'm really focused mainly on safety in buildings and using the data that's there today to make a massive change and cut down the energy wastage and try and get to our net zero 2050, which, my God, we are a mile away from. But anyway,
100 miles away from that. We're not a mile. We're like we're
so far off. It's unbelievable. But anyway, we can, if we stop procrastinating, get there. But procrastination's a great invader.
Yeah, nobody does anything unless there's a crisis.
I know.
That's what happens. Oh, very cool. Mr. Auerbach is in the house. This is so awesome. All right, David, he's on mute. He must be in the middle of doing something, but we'll get to him in a second. So, Deanie, there's more news. I'll go to you since you're first. There's more news about hospitals closing and things like that. And not sure what that's all about. I don't know if that has anything to do with, but it's rural hospitals. And I'm not sure if there's a trend there or if it's just they're privately run and so they're just closing. I don't know. Have you heard anything about that?
Sure. First of all, most of what we're talking about are those hospitals that are small, 50 beds or less. Right now, reimbursement from the federal government helps those that are considered critical access hospitals, which are 25 beds or less. But that gap between 25 to 50 is not helped from a reimbursement standpoint, from a cost. They use a cost report. And so, and they're having a very hard time finding physicians. The incentives of recruiting physicians to rural areas is not what it used to be. So you've got reimbursement issues for the hospitals and you've got lack of physicians. I think what will happen, many of these rural areas are very important to the various congressmen. And I think you'll probably see that there will be support for reimbursement to keep these open, because many of these are county hospitals that should close probably if you looked at it purely from a bed standpoint and what's needed. But people would have to travel 30, 40, 50 minutes to get to a hospital. And most people think that's too far. And so I think that's why Congress will probably find a solution.
Interesting. I love that.
That's the way it always is.
It is. And the other thing about the private, and Paul is just shaking his head. He's like, you Americans are crazy because we don't have this over here in the UK. But
Oh, we have problems somewhere. We have problems, but not those problems. Yeah.
Yeah, exactly. We have different problems. But I actually have a friend who it's a private, but they do ambulance service, right? Because there's a lot of the ambulance services that are private too. She's facing the same thing. She's not getting reimbursed from certain so it's very difficult because a lot of some of them are counties, and so the counties are the ones that, so it trickles down to all these other people that are providing services. I mean, she's owed like in the millions of dollars from some people for providing ambulance services to certain places. I don't know how that all works. I don't understand the business behind healthcare,
Yeah.
but it's kind of interesting. So she's
And
almost,
in some of these, right, in some of these rural areas, the hospital may be one of the largest employers, and that's another issue. If it closes,
yeah.
those people are out of a job. The other businesses, whether it's ambulances, all the other things that are support functions around the hospital, go away.
Mm-hmm.
However, having hundreds of hospitals that are 50 beds is not an efficient way to do healthcare.
Oh.
But we've got to find a solution.
Yeah, for sure. Well, if Congress gets involved, nothing's going to do it, and it's not going to go right.
No, it'll just be money.
It'll just be money. Yeah, because they think money solves all problems. I don't know. Maybe it does. Who knows? Not sure. Well, I'm so glad David's here because my next thing was talking. There's a lot of movement in the REIT space. Hi, David. There's a lot of movement in the REIT space, even on the healthcare side. Like Welltower was looking to acquire Realty Trust wait, I'm sorry. Don't listen to me. That was years ago. But there's some stuff happening in the REIT space. I'm just gonna let David talk about it. Not me. I'm not gonna even go there. Hi, David. How are you?
What's going on in the world of healthcare? I guess you have news for me. I do know that there is a potential healthcare REIT coming to market, internalizing management. It's the old Healthcare Trust of America, HTIA. It's part of the AR Global, Nick Shork Enterprise Healthcare Trust REIT. So they're talking about a potential 2025 IPO on that platform. M&A is obviously, I would still say, alive and well. We're coming out of earnings season right now, and we published, let me pull up our earnings piece actually, just because it's timely. We did just publish at my research provider, Hoya Capital, we just published our earnings recap piece. And I will read to you here the big takeaway from our earnings note. Of the 96 REITs that provide full year guidance, just under 60% of them raised their outlook for this year, while 14% of them lowered, well above the second quarter average raise rate of 40 to 45. So they beat it by 20%. S&P FactSet says that 53% of the 272 S&P constituents that provide EPS guidance also issued a positive revision. So, right now earnings are tending to tick higher for many of these companies, which is translating also into higher dividends. Obviously, we did get a boost last week in that whole market volatility mess when volatility just shot up. And as a result, the 10-year treasury, frankly, rallied to like a 318, 319 handle. And now we're back up into 385, 386. Yeah. But in the same breath, what we're seeing is that, we had 2 REITs issued debt deals last week. We've got another 2 that have announced today. We had 2 that priced yesterday, 2 more that priced today. And what's happening is that, by and large, most of these guys are borrowing money with a 5 handle on 5 to 10 year notes right now. And it just takes, the takeaway is the lending window is open. There is capital that is out there. You have investors that are frankly going on offense to acquire properties. There's a great article published on Bloomberg today that interviews Larry Silverstein. For those that don't know, Larry Silverstein owned the World Trade Center and redeveloped the World Trade Center. And he's coming out saying there is massive opportunities to acquire some of these distressed New York office assets and convert it to residential, which is very interesting that Larry is saying that, because one of the pushbacks that we get from a lot of these folks on office to resi conversion is the price tag, how much it costs to convert. And Larry is basically implying prices have gotten so discounted that it's worth the cost to convert right now and put it to better use. So, remember, as fund managers from where I sit, I don't look at the day-to-day. I mean, I do focus on the day-to-day, but when I talk to advisors and investors, it's that long-term vision of what this looks like. And so long-term vision from where we sit is Fed is going to cut interest rates. Don't know when, but let's say September. The Fed's going to cut rates. Yields will go down, cost to borrow goes down, hopefully mortgage rates go down, everything gets better. If there is this consumer slowdown that we're concerned about, I push back and say, go to Las Vegas. Have you been to Las Vegas recently and seen what it looks like out there? We may have some pockets of the economy that are slowing, but there's other parts that are just really firing along. I mean, if you follow my LinkedIn, you'll see I posted a ton of content recently, highlighting basically the what's to come for a lot of these sectors and companies that are out there. And it's basically placing your chips on the roulette table now for when the ball lands here in the next several weeks.
Yeah, for sure. And I love your LinkedIn posts, by the way. They're super insightful and I read them all the time. And if y'all do not follow David Auerbach, you should follow him. But you didn't get to introduce yourself. So go ahead and tell everybody how cool you are.
I'm an annoyance to Amy on a weekly basis. I don't want to be working. I'd rather be at Fish concerts. I'm heading out tomorrow to Philadelphia. But I'm a REIT portfolio manager. I manage 2 real estate ETFs with a partner of mine at Hoya Capital. We run the high dividend yield ETF, high dividend yield index, ticker RIET, and the Hoya Housing Index, ticker HOMZ. I'm the publisher of the daily REIT Beat newsletter that covers all things happening in the REIT industry on a daily basis. I'm a REIT industry consultant, network extraordinaire, but I live, breathe, eat, sleep the REIT sector.
Awesome. And thanks for coming. It's always good to have you on the show. Hey, Paul, how are things in the UK?
Things are good. I mean,
are you prime minister yet, by the way? Because you're Irish, they're like, nah, he's not getting it.
I thought we said president. Okay, come on. I mean, surely. Although with Camilla Harris. I'm going to say to American politics. Okay, it's probably best on this one. But things are okay. I mean, we did have that 1/4 point interest rate cut, which is like, let's face facts, absolutely nothing.
We're so jealous of you. We are so jealous over here. I'm telling you.
But the impact of that 1/4% has been completely disproportionate. So it's suddenly going to be like, oh, great, let's pile in again. And house prices have gone back up again. And I keep on saying, my God, it's so disproportionate, as I've said to you before, to salaries. But house prices just soared as soon as the interest rates came down by 1/4%, which is absolutely piddly squat, as we all know. However, what we are seeing now is that there is expected, although we've now finally hit our inflation rate for the first time since, I think, 4 or 5 years, there's now signs that inflation's going to creep back up again, which I usually see, by the way, very early, which I never understand why people don't notice the price of shipping containers coming around the world. When they suddenly spike, you're usually going to have inflation several months later, but no one seems to see that indicator, which I've seen forever and a day. But that is what's happening right now. So we're seeing containers going up in price for the last few months, and now we're going to see inflation, I think, kick back in a little bit higher again. I honestly, gut feeling is they're going to keep interest rates for fairly long. We're not going to go back to that fantastic period we just had of 15 years of no interest rates basically around the world. I think we're going to keep it there for a while. I do think, as you know, I've made it very clear about this. It's all great, when prices are sky high, but socially, I think we're going to end up with a really big issue unless we get back to some proportionality on salaries to house prices. In particular, I mean, commercial is different, but I'm hoping we see that come into play sooner rather than later. But things are good here. I'm seeing a little more positivity. I mean, the weather is good, which is very unusual here. And yeah, there seems to be, we seem to see from our statistics anyway, coming through, more people coming back into the office a little more, which is great.
Uh-huh.
And there seems a bit more vibe around the place, around that increasing. So yeah, positive over
But
here.
climate change has made London the hotspot for tourism. Like, there
Oh
you
yeah,
go.
only for 3 days of summer, okay?
For 3 days of the summer. Ah, that's crazy town for sure. I think it's really kind of interesting how yes, the whole thing with inflation and pricing and everything, and we're all going to be in this quandary. And you were talking about, where it goes or where it moves to. Obviously, real estate is very interest rate sensitive, and I think we're stuck in this thing for a little while. I don't think it's going to kind of go away. We had one bad jobs report, and I think everybody was doing cartwheels. Yeah, I think that's what the Fed was waiting on, that our jobs are going to slow down, everything was going to kind of slow down, things were going to contract, and people weren't going to have jobs, which is sad that they have to wait for that, but that's what they typically wait for. They don't call a recession until so I think they're waiting for another month, and hopefully people will stop hiring people. I just don't know this is just a weird time. Like
But again, it's a disproportionality. I mean, the stock
yeah,
market in the Far East crashed on the Monday, and then suddenly, America crashes in the afternoon, and UK crashes in the afternoon, America crashes in the evening, and and the next day the stock market's back again. You're thinking, really, I can't believe here we are in 2024, and we're still acting like lemmings. Everybody starts selling, everybody's buying it. It's like,
yeah,
please get a grip. Take it with a pinch of salt, and think about it a little deeper. But yeah, it
yeah,
was quite amazing to see the Far East stock markets literally have to cease trading. I think Japan and some are going to cease trading on that Monday, on the back of the employment figures from the US. But
yeah.
yeah, I
It's
certainly, I mean, from my point of view, I see AI really kicking in harder and harder in my business, disproportionately fast. I mean, I've been doing AI for 20 years, but this has just got on a different level, the acceleration right now. And I
yeah,
think this is going to have a big effect. And we see people around us here, in the banking sector who I know personally, who've got like 2 master's degrees or from JP Morgan, etc. And they're sitting here struggling to get a job. And I see some fine brains out there, which I am shocked are not being snapped up, because actually I think a lot of the big corporates are looking at AI now deeper and going, before we start plowing in,
yeah.
let's just see what AI is going to give to us. So we've got
Well,
interesting times.
yeah, no, for sure. There's two stories that's taught there. One of them I want to talk about that, and I'm seeing this in the news, so I did want to talk about this. And the visceral reaction to like that market, the thing that it did last week. I think everybody's been holding their breath and like, when are we at the bottom? When are we going to come back? I mean, this is like anticipation that we're coming back. And so then a lot of the news stories were like, oh, we're at the bottom. I've seen these for like weeks. We're at the bottom. We're at the bottom. We're at the bottom. Well, yeah, look, my crystal ball broke a long time ago. I don't know when we're at what bottom or where it's at. I mean, I don't know, but if anybody wants to jump in on this whole thing about we're at the bottom, or we're gonna, I don't know.
Yeah, so Market Watch published a story this morning interviewing like the head of research at AEW, as well as like the head of income strategies, a friend of mine who's at TCW.
Mm-hmm.
And, the story leads real estate stocks have hit a bottom. I
Yep.
mean, I if everybody says we've hit the bottom, have we hit the bottom? Separately, I think everybody knows who John Gray is. John Gray was literally just interviewed on CNBC on the set
Yep.
about 10, 15 minutes ago, and highlighting, what Blackstone is looking at and, their push. And so, I think with distress comes opportunity. Volatility equals opportunity. Nobody can perfectly time the market. And so I think the problem is that if we sat 8 people around a conference table, you'd get 8 different answers of if we've hit the bottom or not.
Right.
And regardless if 3, 4, 5, 8, or 1 say yay, the general consensus, yes, we are approaching the bottom. But are you really going to add that much to the bottom line between doing it today versus tomorrow versus next week? If your conviction is we're there, then go ahead and start getting into it. And
Mm-hmm.
so I think it's, because I have these conversations with advisors all the time, and it's like, well, if REITs hit bottom, I go, I can't answer that question. Here's what I can tell you. And you lay out the facts for them. Because again, what makes X company a buy to you makes it a sell to Deanie, and what makes it a buy to Deanie makes it a sell to you. No two investors are alike. You have to figure out what's important to you. But again, if the value is just so too compelling to pass up, especially in the world of REITs, because all these REITs, literally every single REIT is trading at a discount to its net asset value. And so if I can add up all the sum of the parts of what some of these assets are worth, like the Empire State Building as an example, and own the stock for pennies on the dollar, are you going to really make that much more by waiting another week until Jerome Powell comes out and says, we've hit bottom, it's time to buy? Like, when the Fed cuts the interest rate, that's officially the bottom for the REITs. And then, as I say in my marketing, any interview, when the Fed makes the announcement at 2:00, at 2:00 in 1 second, the REIT sector is going to rally. And at 2:00 in 2 seconds, the advisor is going to start calling grandma and grandpa, mom and dad, saying, hey, the Fed cut interest rates, it's time to buy REITs. And that ship has already sailed. They missed that boat.
Yeah, no, I good call, right? For sure. Exactly. We all should buy Deanie's REIT, just saying, because
But David, are you going to see
You
maybe?
What about my
can
REIT?
say that.
What about my REIT?
I can't
I
say
know,
that.
I know.
You say that. I can't say
Deanie
that.
can't say it. Paul
can't say
Sheedy's going to
that.
be prime minister, and we all need to buy Deanie's REIT.
What about my funds? What am I, chopped liver?
Oh no, because no. Your fund is going to explode. Sorry.
Wow, I see some favoritism here. Paul, I'm sorry, I didn't mean to cut you off.
No, don't worry, David. I've got to say, so obviously what I saw here was a quarter percent cut on interest rates, which is, let's all agree at 5.25% down to 5 is nothing, okay? In the States, if you go down by maybe 0.25%, so if the Fed decides to be careful and do it slow and steady like the UK has just done, even with something which really is a rounding error, you're still going to see that shoot up, or you're looking at the Fed cutting by a whole percentage point, or what it's going to take? Is it just literally anything will set off?
I would be absolutely flabbergasted, shocked beyond all belief, etc., if the Fed cuts it a full percentage point. In fact,
no,
there's a better chance in hell freezing over than the Fed cutting it a full point. Number one.
I agree.
Number two, you bring up a good point, because I do get asked that question frequently. Even if it's only a 25 basis point cut, do you see it profoundly impacting the REITs? And I think it's a kind of a layered answer, because really on the surface, the answer is yes, it is good for REITs. Is the performance amplified versus a 50 basis point cut? No, it may not be as extreme, obviously, on that performance side of it. But I do think that the general sentiment of the first interest rate cut does bode well for the sector. And as Deanie can attest to, when everybody says REITs are interest rate sensitive, if interest rates are going down, thus REITs should go up. That's why I think we'll see some of that follow through effect. But I think it's a very good point, because 25 basis points really isn't that incremental of a cut. And I think you made a good point earlier, because you go back to COVID, when the 10-year was sub 1%, there was 0% interest rates. It literally was free money out there for any and every single company that wanted to borrow. And now people talk about this wall of debt that's coming due for commercial real estate. Oh my God, doom and gloom because of wall of debt. And I get kind of animated about this, because when you think about commercial real estate, there's REITs and there's C Corps and there's all this stuff lumped into one umbrella. And because of my lucky relationship with some of these REITs and with the disclosures and the transparency, all of these REITs will go out there and tell you, we don't have a wall of debt coming due. We know how to manage our debt load for the next 5 years, 10 years, 50 years. We know what's coming when it's coming. But why this is important is because we're not going back to those free money days. And oh, by the way, yeah, there's this wall of debt that's coming due for commercial real estate. But what the Jim Cramers and the CNBCs and the Bloombergs of the world don't tell you is Microsoft and NVIDIA and then Netflix and Apple and every single one of these other companies also have a wall of debt that's coming due. And what kind of gets swept under the rug, if Microsoft takes down a $10 billion deal and they jump in the interest costs from 3% to 5% or 2% to 5%, what's the incremental interest expense that Microsoft is facing on that new debt stack, which is probably greater than the market cap, obviously, than a lot of REITs. You know, we can't compare the two companies. But what I try to say is every single company is navigating the same debt markets at the same time right now. It's not fair to lump the REITs in with this when every other company is out there dealing with that same pain. So going back to what we started here, a 25 basis point cut is going to have negligible impact on the 10-year treasury rate and the federal funds borrow rate. But at the end of the day, the cost of borrow does go down.
Amen. I got you.
And it gives you that breadth of, okay, we can get through this sort of situation and get back on track.
Well, it's high for long.
But
the REITs have been operating in this high for long environment that you said for so long now. Higher for longer is out the window. It's high for long. And the key, and again, you know, it's great that Deanie's here because he's got some good insight on this. Go ask any REIT executive, what are they doing right now? They put the blinders on. They focus on fundamentals. They focus on that which is in their control. Interest rates and federal funds and all this stuff, that's out of their control. You have nothing to do with that stuff. So all you can do is, how do I maximize my revenue growth, minimize my expense growth, maximize my NOI so that I can push out as much income as I can to my shareholders?
And David, I was going to ask you in terms of like the whole move to net zero and efficiency in building, sustainability, etc. Are you seeing that having a big for those who have taken the step already and start moving in the right direction, which we all have to do eventually? Are you seeing their asset values increasing substantially for those who have now got a grade A building with highly efficient, or what are you seeing over there in the States?
Actually, the timing is really good that you say this. NAREIT just yesterday published an update looking at sustainability initiatives by the sector. And so there's a very, very, very good detailed piece out on NAREIT's website. I actually reposted it today on my LinkedIn, so you could check out the link that's there. You know, I don't know if it's necessarily priced in. You know, I think it's very tough. I don't know if anybody watches Industry. The HBO show Industry just came back this past Sunday, and they have an ESG focus this season, talking as one of its plot lines. And I think it's really interesting because it brings up a deeper question. Is ESG really a fad, or is it something that's really here to stay? And I know it depends on the audience when you ask that question, but I think for a lot of the big time money managers that's out there, I think ESG is almost at this point a forgotten checkbox. What was so relevant just a couple of years ago, I think has kind of taken a little bit of a back seat. And so I don't think I don't think they go hand in hand with each other necessarily as much as it did just a couple of years ago. Look, the goal of any of these REITs and any of these investors and stuff is you want to own the best properties in the best markets at the best intersections, that you have something that can't be replicated, that Warren Buffett type of mentality. And you can't just go out and start up a lab space REIT. You can't just go out and develop a lab space office property when you look at the CapEx to build that out versus your typical 10-story office building. And I know Deanie can comment more on that. You know, I just look at the best assets as an example. The Empire State Building, Embarcadero Center, One Vandy, some of these trophy assets across this country, they ain't going anywhere. And if Empire State Building goes out of business, we've got much bigger issues going on than the Empire State Building going under.
Yeah. Go, Deanie.
I will say that David's right about focus. The REITs that have their balance sheets ready for this are really in a great position. And we've all been looking at that for the last 12 months, waiting. And that clearly is where we are. And on the medical side, we've benefited from not having to worry so much about alternate uses and vacancy and things like that, like the offices. I mean, the commercial office and commercial office converting to medical is not really a threat. So, you know, we're fortunate on that side, on the medical side. If you've got your balance sheet in position and you get some movement in interest rates, you can take advantage, not of the other REITs, but you take advantage of the private owners That's
Right.
where the opportunity exists.
Yeah.
So the takeaway here is that HealthPeak is going into the office to MOB conversion. I'm being a smartass.
No, no,
I'm being a
no,
smartass. I'm joking. I'm
no,
joking. I'm
no.
completely
I
joking.
tell you what, can you shut him off? I don't know how you do that, but yeah, you got to take that off.
I'm completely joking. Pure humor.
For
Oh,
humor, you said it 10 times. Well, okay. So what I would say about the ESG thing though is there's an article out in the Wall Street Journal about what do better managed companies have, and they have a lot of climate related jobs. So in climate in managing risk, right? So climate in reducing, costs, climate in, okay, how can we manage our supply chain so we don't have disruptions in, because of weather related events or whatever is happening. I think that stays. I mean, but I know there was this big push a couple of years ago for sustainability officers. You had to have the chief sustainability officer, and that's kind of going away. But I do think that as far as optimizing your operation, I think that is what everybody should look at. I mean, that's the benefit of having an ESG kind of component in there.
I mean,
No?
if you want to get in with some of these big time investor guys, you do have to have an ESG focus. And
Yeah.
it's not just part, as I say this, it's not just doing a token hire. You know what I mean? Like you really have to embrace it, follow through with it, be proactive with it, and it has to have a track record, especially for guys like an Engine number one and some of these other big investors that are out there. It's not just, okay, we're ESG compliant, here we go. It's we've been ESG compliant for 3 to 5 years. Here's our proof in the pudding. And that's what is able to tip over some of these guys, especially as you go overseas towards some of the big sovereign wealth funds and stuff. It's great if you have performance and all this other stuff, but if you don't have a long-term track record of doing some of this stuff, we don't care who you are, you're not even going to get a seat at the table, which is important to me, again, as a fund manager, because I represent, 100, 200 different REITs and stuff in my funds, that if I'm sitting down from Abu Dhabi Investment Authority and they start asking about my constituents, like let's use SL Green as an example. You own a New York City office building. How ESG compliant are you when you've got AC running, the lights, the this, the that, the this, and I've got to be able to point them towards SL Green sustainability practices that they preach to emphasize, here's why this is a good story. Now, take a step back. Is our investment philosophy in SL Green based on their ESG practices? Absolutely not. But I better have the answers in my pocket in case I do get asked that question. What are these companies doing to combat this growing problem?
Yeah. But don't you think that over time, so in the UK, there's a lot more regulations around ESG. Don't you think that's just headed to the US? At some point, it's coming. I mean, it's in New York already. It's already in New York, in
Yeah, I mean,
California.
I think in New York, especially because obviously we saw this before COVID was coming along, that New York were going to clamp down and really set the pace. My gut feeling is that post-COVID, with obviously low occupancy rates and now very high interest rates, I think maybe the government just had to ease off and say, you know what, we'll let it go for now. But I do think once your interest rates are going up, down and all the enthusiasm come in, I think they're going to have to go back on that road again. My gut feeling is, I commented back on a piece this week, actually Monday, where I had the usual, anti-China piece about, maybe if we stopped importing everything from China, the world would get better. I had to explain to the person who put that ignorant comment out that actually the biggest polluters in the world are the Middle East at 19.5 tons per person. And then we go to Canada, and then we go to the United States at 14.7, and then we get down to China at 7.1 tons per person. And explain that actually, there's some big offenders out there in the world. You'll be wiping out all the trade from South Korea, Germany, United States, Canada, and the Middle East before you even get down to where China is on ESG and emissions per head, which is what it's all about. My gut feeling is I think that, I was at a speech, a few weeks ago with Amy with John Kerry, and John Kerry was very clear where he's going on this, and he's launched 5 weeks ago along with Chris Skidmore here, one of the very honourable MPs who resigned over the UK government going back into oil and gas fields exploration. and they launched the Global Climate Action Group Coalition, Global Action Coalition, and they were very, very clear that this is about finding the best practices in any country in the world and just imposing this. I mean, looking at a country that has similar weather conditions, or certain sort of scenarios where a lot of the Middle East where it's very hot, or some of the countries where it rains a lot, or you got rivers, or you got cold, whatever it might be, and looking at what are the best practices to really accelerate where we go. I think the US has got a bad it's in a bad position right now, and it's right up there top of the league in terms of sustainability. It's CO2 emissions per head, I should say. And I think when we see some stability going back in again, we're going to see the governments of New York, etc., imposing these ESG standards and sustainability standards again. But I do think the asset values will go up substantially for those who have made the move.
Yeah. Well, yeah.
You know, talking about sustainability and what's going on in New York and in Boston with these laws and regulations that have passed, the ULI Healthcare and Life Science Council, we've been debating between the U.S. and Europe how this is impacting. And I spoke at the European one in Milan, and it is clear they're ahead of the U.S. There's no question about that on sustainability. I question if even the laws being passed are going to get, at least from a healthcare standpoint, hospitals and others to meet the standards that are being required. And the other question that's going to come is who pays in the medical office space when the penalties come? I've been asking, does the tenant pay the penalty that will be put on the landlord in the lease? Because the sustainability requirements in New York and Boston are very stringent, and it's unlikely people are going to meet the targets and they're just going to pay the fines. That's not the European way. From what I was with the European Council, they don't believe that. They fix it. They correct things. We'll pay the fines. You watch. That's what'll happen here.
So even though the tenant's responsible, pretty much, the landlord will end up paying it. Yeah.
Yeah, the landlord will pay. Yeah.
Yeah. Yeah. Do you know that in Australia, I was talking with Gavin Towers, whom Mr. Sheedy knows. I was talking with him the other day, and he was saying, because he has an Australian and UK company in Australia, if that building doesn't meet some ESG regulation, the tenants can ask for rent decreases. That's law in Australia. No, but that's what.
No. Please don't talk about that in the U.S. Some council person will want to pass that regulation.
I know. Isn't that crazy?
Yeah, it's great. I actually had lunch with Gavin on Friday, along with the head of Wells Certified, and we're gathering our thoughts about how we collaborate tighter and harder together. And certainly, I think what Gavin's company is doing is fantastic, and we're completely engaged with Gavin on many buildings now, because I think he's a classic sort of person in my ecosystem, where we all do something really well, and the more we all join together, it's going to happen. And what I would say to you in the US, don't stress about the cost. There's actually a lot of this, and what I'm really working with a lot of companies is how we use these technologies that are easy to implement to save you money straight away and give you a rapid ROI. So I wouldn't be too stressed about these huge, we hear this $9 trillion to solve the world's problems. I don't think it's anywhere near that. I think there's a lot of easy fixes that actually would be good for your bottom line right now. So that's the line I'm spreading, okay?
Yeah, I know. I feel you for sure.
That might be the cost, though, to fix the grid in New York. That's probably
the bigger issue. I know that
yes.
That's
Danny, this is exactly the issue in the UK. So the whole moving to renewable energy is fine, no issue at all. Wind farms, you can't get the stuff onto the grid because the average age of an electrical engineer in the UK is 56. Nobody's going to that industry. And what I'm trying to insulate is, let's give apprentices double the salaries to go and be electrical engineers and get on and do this. But there's always an issue there with renewables. And our issue is we can't get the energy onto the bloody grid in the first place, which is the Achilles heel here.
So where's it go? Do they have wind farms? Where's the energy go? Into the I don't know,
No, right
metaverse?
now
Like,
it's not working. So you can build all the onshore. I mean, we just brought in a new law to accelerate onshore wind farms. So it's all offshore up to now. But like the issue is like, great, we can do that, but how are you going to get the bloody energy onto your grid, people? And this is something I've been ranting on about for probably, I don't know, 18 months, 2 years going, yes, but we have to connect it. We need manpower or woman power even. And sort of thing. Do anyone want to dig holes? And no, Amy doesn't because her nails are too nice. But this is the issue. Like we have to look at the whole issue here. It's not just about getting it's not just
mhm.
about getting the renewables in the ground. It's about how you get it onto the grid. And this is just, it's so silly. I get frustrated about this sort of stuff. It's just
Call
so I'm
Sheedy for prime minister. I'm telling you, man, it's just the
you have to
world that
stop.
just
Okay.
makes so logical sense. Yeah, I
You
know.
can be my campaign manager, okay,
I
Amy?
am. I know. I feel you. Okay. The next article, and I find this one interesting because we're in the middle of a housing crisis, and I was really shocked to read this headline. This one has to do with housing, so David and I can chat about housing for a little while. But the HUD lending is at a 12-year low, so there have not been enough transactions. No, and HUD typically is in the affordable. Even in the affordable space. And I was really shocked by this headline because typically in the last, I don't know, year or two, affordable was okay. Like you couldn't make anything in the middle, but you could build luxury, not all day long, no big deal, because that price point would pencil. And you could build affordable because you were getting subsidized by whatever. But now, apparently, even on the affordable side, I mean, HUD is primarily the lender in the affordable space. It's the best kind of debt you could ever get as a multifamily developer. And because they lengthen out the loan, the amortization length is longer and is usually lower interest rates. So if you're an affordable developer, you hang out with HUD. HUD is your friend. But 12-year low, like that's insane to me. I mean, even way back down, if I do 2012, 2013, they were building more than they are today. So have you heard anything, David?
No, I haven't, besides what you're saying here. But what's interesting is that you still got like Fannie and Freddie that are out there lending. Like they're not seeing any slowdown as far as I know.
Yeah.
We talk about this lack of affordable housing that's out there. I mean, this goes back to our clubhouse conversations. I mean, we've been talking about this for years and years and years, and we'll be talking about this for years and years and years. This story is not going away, and so I think how to eventually pick it back up. Again, not that I know anything, but obviously there's other sources that are out there, including the big banks, the JP Morgans, the Bank of Americas of the world, sovereign guys that want to get into the space, et cetera. I do think that there's a lot of lending parties that are out there to help support the industry.
Yeah. There are. I was amazed by this headline. I was just like, what? This doesn't make any sense to me. But yeah, Fannie and Freddie are active in the space. I mean, the transactional volume, let's be real, in multifamily is probably dropped, or even commercial real estate. It's a third of what it was previously. And so it could bear to come fruit when you're not going to have a lot of loans processing because there's not a lot of deals happening at the moment, for sure. And everybody, but back to the other question of even if they drop the interest rates, this all comes full circle, y'all. Even if they drop the interest rates down 20 a quarter or even 50 basis points, right? Don't we think that it's already been priced in? Don't we think everybody's already expecting that to happen? And so therefore there's not going to be a lot of movement. I mean, maybe if they
Yes,
went higher, they would go, oh, hallelujah. Okay, let's go. But yeah, I don't know.
yes, but I think it's also there's all the buildup and then there's the actual announcement. So the fact that it's actually official, it hits the tape, it's legit. More importantly, think about the typical Federal Reserve press, announcement cycle. Everybody kind of knows what's coming when he makes the announcement at 2 o'clock. It's what's being said at 2:30 at the press conference. And I think that's where I think advisors, investors, people in the middle, that's what's going to be the more curious thing is what's the rhetoric coming out of the press conference to get a sense of, is this one and done? Is this the start of a bigger program? What are the next steps to be able to see the next cuts? Because he's been talking about this 2% number for 2+ years now, it seems, at least more. It's okay. So, all right, we're at 2%. You cut the rates. Now, what's next target to get to that next level? So, even though it's going to happen, the rhetoric and the questioning is still going to continue for many months thereafter.
Yeah, and reading between the lines because he knows how to be vague.
Amy, my apologies. I have to drop for my next event, but I look forward to trying to do this with you again next week. And Deanie and Paul, it's great seeing you guys.
See you next week.
Sorry, Paul, Deanie, I was
Yeah,
just joking. I promise. I was just joking, Deanie. Bye, guys.
Bye.
One taking.
You know, David's a character. Yeah, tries to get everybody in trouble. Serious troublemaker there. You know, as Texans, I don't know if y'all know this, David lives in Dallas, but yeah, as Texans, we try to get everybody in trouble. We do. So as far as the healthcare space, Deanie, overall is fairly insulated, or is it not, from most of these movements with, I mean, people still get sick, people still have to go to doctors. I mean, there's not a whole lot of, other than what you were talking about with the bed thing, but on the medical office space, it did well during COVID. It just is very resilient. It just kind of hangs there, right?
Right. That is right. The thing that we are seeing, though, is the cost of construction and the cost of debt has really caused the new development to create rents that are much higher than people anticipate. And what that's led in the marketplace is really the movement of all rents have gone up. So traditionally medical has been in that 2 to 3% annual increase. We now have moved to 3 to 4. So that's the piece that we're, but that's all good for the landlords.
Oh yeah, for sure. It's not, I mean, as long as you're able to cover, right? It's not like us multifamily people where we can't raise rents anymore because nobody can pay it, right? And so we're in that squeeze. We're in the squeeze where all of our expenses went out here, and now we can't raise rents anymore because people don't have the income to pay it. So it's different ballgame for sure.
And most medicals triple net. So it is a good space to be in from an asset class. And physicians don't like to move. It hurts their reimbursement. They have to reapply. It's just a nightmare for physicians to move.
Wow, I did not know that. Man, I should buy medical.
Oh yeah. Oh, it's a real process. It's a cash flow issue if you move. It's a real cash flow issue.
Wow, that's crazy town.
All your commercial payers, all that.
So if you move, let's explore that. So if a doctor moves, do they have to get it like pre-approved, or like, is it like a big?
No. They don't have to get pre-approved, but they got to fill out all new paperwork with carriers, with new addresses and all of that. And that just gives the opportunity for the payers to slow down while they approve that. And then,
Lovely.
so it is a cash flow issue if a physician wants to move their office.
Like 60 days? 90 days?
Could be 90, depending on how efficient they are in filling out the paperwork.
Holy crap, a quarter? They wouldn't get money for a quarter if they moved?
They could.
Holy buckets. That's crazy town. That would make me want to.
That's why they don't. They like their patients to come to the same location, and they don't want reimbursement issues.
Yeah, I feel you.
That's why they're good tenants. They're perfect tenants.
That's awesome. So is the whole, do we see the aging of the population, and people staying longer that will drive a lot of it, where the folks move to will drive the next locations where people want to be. Is the Sun Belt still the play? Is it where everybody's retiring to Florida and we're all going to wherever the retirement village is? I don't even know the name of it, but is that driving a lot of the medical office play now still?
The Sun Belt's still the relocation of the elderly to that area. But the other thing we're seeing is that, besides senior housing, all of things, you're seeing the development of post-acute facilities, such as inpatient rehab, all of that, because there's a need for that now, and it's growing as people age. So that's a growing development area. But the Sun Belt, that whole area is still major growth all the way across to Arizona and into there.
Have you seen anything? So an architect friend of mine had this idea. I'll throw it out there. I think it's nice. Where you had these centers, not only was it a health center, but it was a wellness center talking about we can grow you, teach you how to grow organic food and, you know, have all this stuff that in the, and just like a whole campus around that is that becoming a thought in anybody's brain around doing
Sure,
anything like
sure,
that?
sure.
Yeah.
There are developments like that. And then
Yeah.
they take it right on into senior housing and
Yeah.
various step down units, all of that. But
Yeah.
you start out with living in normal, either condo or small houses with all of that wellness associated with it, with the medical provider right close by. Sure.
Yeah, interesting. Yeah, well, we'll have more and more of those pop up. Sun City, Georgetown, Texas is going to need an organic farm or whatever. I don't know. That's the only one I know. I don't know any of the I can't remember any other names of them. Do they have those in the UK, Paul? Do they have like these retirement village communities and
Yeah, it's becoming a big thing here, actually. We're seeing a lot more of the sort of wealthy going into these fantastically five-star nursing homes with like every facility you could ever imagine, stunning places. But the cost astronomical. And actually, a big issue over here in the UK is that when your parents get too old and have to go to the nursing home, you kiss goodbye to your inheritance because it's like thousands and thousands of pounds a week, and you sit there going, damn, that's the inheritance gone. And I think in the UK the government can take all of it down to like £23,000, and they can leave you with, and that's so it's a big issue. And as I said last time, we're not living longer; it's taking too long to die.
we're
And
taking
actually, one of my points here,
Yeah.
we are. But my point here is I actually think we should be educating. Now, I don't see the financial benefit for the US to do this, but I think in the UK, what the NHS should be doing is educating people on, various medical things, especially, when a woman gives birth to a baby, there's always like an NCT class, but also they should send them on a medical weekend away to teach them about all of these main 20 or 30 things that could happen to your baby, will happen to your baby in the first 6 months. You call a doctor for this, you don't bother with that, you get to the hospital on this. And actually, I think there should be a TV channel where you go through and it tells you, okay, if this symptom is here, now call the doctor. We've got to start educating people more because I see a huge waste. The problem is the more and more we're curing more issues and illnesses, which is great, the more and more it's impacting the health sector and the costs are going up all the time. And I think it's a really important thing, certainly in the UK, for the NHS to start switching around their philosophy to educating us and telling us about, the cost of the fact, quite frankly, luckily, touch wood, I rarely see my doctor. I can't even remember my doctor's name. I might go once every 2 years, but we should get a statement each year saying, Paul, you saw the doctor 3 times, had one minor operation, you cost the NHS this much money. And then somebody who's abusing it, who goes there for a weekly catch up with the doctor, show them how much they've actually cost the NHS and make it quite clear that, it's cost 6 people's tax money for you to go and see your doctors frequently. And maybe you need to lose some weight, or maybe you need to do X, Y, Z. I do think we got to be a little more brutal and, huh?
You said lose some weight.
Yeah.
See, this
Run to the
is
doctors.
a foreign concept to us in the US because we don't have a universal healthcare system. So we're just like, what the heck are you talking about, Paul? But I mean but around the world, they do, other places around the world, they do, right? So Canada
Yes.
does, and a lot of other people. So it does bring up different issues for sure. Different
I think
issues.
there's a lot more responsibility. I think you need to understand that there's nothing free. Like here, that people see the NHS as free medical healthcare, but it's not. Of course, it's not free. It's paid by taxpayers, but
Right.
there is a lot of abuse goes on here and a lot of stupidity I've seen for many, 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 many years. I mean, I know too many doctors, quite frankly, and I hear the stories and I go, "Oh my God, why can't you say something? Oh, we can't. It's politically incorrect to say anything." I'm like, I just tell you, get off, give me those cigarettes, or get a pair of training shoes and get out walking.
Well, I
Anyway,
don't know if this is still the case, but historically, the UK, though, has done an excellent job in educating about hospice and end of life issues much better than the US because costs are tremendous at the end of life. And UK has always done a good job of educating around that. So I'll commend you on that.
I can guarantee, because I've actually had a very dear friend of mine died recently, and I have to say, the end of care life is just absolutely fantastic. Couldn't fault it. Couldn't fault. What I could fault was we had a lot of doctor strikes and nurses strikes and all the rest. And this poor friend of mine basically got very unlucky, and they didn't pick up the cancer in time, which is why he died. So actually, it's the doctor strikes, which is why he ended up in the end. But actually, how he was cared for in the end was fantastically good. And I would say there's a lot of great things about the NHS here. I think there's a lot more to do, and some of it's going to be a little politically correct. And I think we need to start waking people up to actually, you can't go and eat fried chicken every day and expect to have a wonderful heart.
And with that segment, there we go. It's the end of our show. Don't eat fried chicken every day. That is bad for you.
Run and catch your own chicken and cook it properly.
Exactly. That's the quote of the day. Don't eat fried chicken every day. It's bad for you. No, this has been a great show. Thank y'all for coming. This is the end of our lovely show. This has been, as always, so much fun. This is a show of the U.S. PropTech Council. The U.S. PropTech Council is sponsored by Lerner and Associates, and we will see all of y'all next week. Thanks for coming.
Wonderful. Thank you again. Bye-bye.
All right, bye.